Let's be honest. 1000 rupees a month doesn't sound like much, does it? But what if I told you the small amount invested wisely could snowball into serious wealth over just 5 years? The real question isn't if you should invest, it's where you should invest. Should you go with the guaranteed safety of a post office recurring deposit or take a chance on the market with a mutual fund SIP? Let's break it all down in this video and help you decide where your 1000 rupees truly belongs. Hi, welcome to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. So if peace of mind is your top priority, few investments match the post office RD. It's backed by the government of India, so stable and totally insulated from market volatility. Simply invest a fixed amount each month for 5 years and earn 5.8% interest compounded quarterly. So some of the key benefits are you get guaranteed returns and there is no market risk. It is easy to open and operate and it is backed by sovereign guarantee. So let's consider an example. Let's say you invest 1000 rupees per month in a post office RD for 5 years. That's a total of 60,000 rupees invested. At maturity, you will receive 69,694 rupees. That's a gain of 9,694 rupees over 5 years. Does it sound safe? Absolutely. But in inflation-driven world, is that enough? Or now let's talk about mutual fund SIP. Unlike RDs, mutual funds don't guarantee returns, but they do offer potential. With historical returns ranging from 12 to even 15% annually in bull markets, SIPs reward patience and discipline. Think of SIPs like planting a money tree. It may sway in the wind, but given time, it grows taller and stronger. So why consider SIPs? Higher return potential because 12 to 15%, sometimes even more, and it is professionally managed and diversified, and you can start with as low as 100 rupees per month, and there is liquidity and full flexibility. And let's consider another example. Like let's assume you invest 1000 rupees per month in SIP for 5 years. So total amount invested is 60,000 rupees. At 12% returns, your maturity value could be 82,486 rupees. So the wealth gain is 22,486 rupees. At 15% return, your maturity value could be 87,342 rupees. So the wealth gain is 27,342 rupees. That's over 3 times the gain of a post office RD if markets perform well. So let's make it visual. Here's a side-by-side comparison presented on the screen. So clearly, as you can see, SIPs outperform RDs when it comes to building wealth. But here's the catch. Can you stomach some ups and downs along the way? Now let's look at the real power of compounding over time. In 5 years, your RD has given 69,694 rupees, while SIP has given at 12% 82,486 rupees. In 10 years, your RD could be 1.58 lakh. Your SIP would be 2.32 lakh, and in 15 years your RD would be 2.76 lakh, while your SIP would be 5.73 lakh, and in 20 years your RD could be 4.38 lakhs, while SIP could be 12.29 lakhs. That's not just growth, that's financial transformation. SIPs can potentially triple your wealth over 20 years compared to RDs. It's the difference between playing it safe and playing it smart. Now let's get real about inflation. India's average inflation hovers around 6 to 7%. RDs give you 5.8%. So even though your money grows, it's losing value in real terms. SIPs with a potential of 12% or more offer a shot at beating inflation and preserving your purchasing power. So the real question is, can you afford not to invest in inflation beating options? Now let's do a quick comparison between post office RD and SIP in mutual fund based on various aspects like First, in terms of risk. So in post office RD, it is government backed, so it has very low risk. But in SIP, in mutual fund, it has moderate risk due to being a market linked product. In terms of returns, it is a fixed return of 5.8% in post office RD, but it has variable return in SIP because it can range from 12 to 15% or even more depending on the market condition. And in terms of being inflation adjusted, post office RD doesn't give you inflation adjusted invested returns, but SIP can give you that. And in terms of capital guarantee, in post office RD there is 100% capital guarantee, but in SIP there is not such a guarantee. In terms of which product is ideal for whom, post office RD is ideal for risk averse savers, while SIP in mutual fund is ideal for wealth focused investors. There's no wrong choice here, just the one that fits your financial personality. So still unsure, let's simplify. If you're nervous about risk, start with a post office RD. But if you're considering investing for the long haul, then go with an SIP in a good equity fund. But do you want the best of both worlds? Then split it, like 500 rupees in RD plus 500 rupees in SIP. Remember, the first step is what matters most. Even small beginnings can lead to massive wealth if you're consistent. So what is the final takeaway in this video? We all want the best investment, but best depends on you, your income, your goals, your risk appetite, and your time horizon. RD gives you stability and SIP gives you scalability. And if you're still wondering where to begin, don't guess. Get help from someone who knows the terrain. So if you're confused between selecting safety and growth, then click the link in the description and book your free consultation with one of our certified financial planner. Let's build a plan that's not just good but perfect for you. And hey, if you found this video helpful, don't forget to like, share and subscribe to our channel for more simplified investing tips. I will see you in an interesting video in the next video. So thank you for watching.
Definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.